Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Savi Jain of 2.2 Capital and Foram Parekh of India Bulls Ventures join me on the show. Thank you to both my guests for joining me. Today on Hot Money, we'll discuss Indusind Bank numbers that came out. The counter did manage to react positively in trade today. Avenue Supermarts came out with numbers, but now our valuations justified after the 15-20% fall that we saw. We talk about the housing finance companies. They are in the eye of the storm recently, with most of the housing finance companies dropping in trade. What's the view for housing finance companies going ahead? And finally, we talk about, since the market is in a bearish stance, any top sell or an avoid call is something that we are speaking to our guest at this point of time. But first one, let's talk about Indusind Bank. The first large cap bank that came out with numbers which were in line with estimates. No shocks that came in, but again, concerns remain in terms of the exposure to ILNFS. But the counter has managed to move up almost over 1% in trade. What's the view for Indusind Bank, and what does Indusind Bank throw up for the remaining banks that come up? We'll ask our guests. So, Savi, I'll start with you. What did you make of Indusind Bank's numbers, and going ahead, how do you see Indusind Bank?
No, I mean, I think the numbers were as per expectation, like you said, and most of these large banks, they have always been performing as per expectation or beyond expectation. So the advances growth was robust both on the corporate side and the retail side, and again the deposit growth was also very good. CASA growth was good. Cost to income has declined. So overall, I think numbers were as per expectation, and barring that contingent provision on the ILFS loan, which led to a subdued growth in profitability. Barring that, I think everything was as per line. So, I mean, the bank is performing as per expectation after the recent correction. I think 15-20% over the last one and a half month. It's not still, it's not at least egregiously expensive. Still, we believe it's reasonably priced, but not a buy at these kind of levels. So yeah, I mean, overall happy with the results.
So how does is ILNFS a concern now for banks, given the commentary that came out from Indusind Bank? Do you think that ILNFS probably is a concern for other banks going ahead?
So I think there's not too much, if you look at the commentary, they said that they have specific rights to specific cash flows from a certain project. So it might be an exposure to an SPV level project, or so it's not right to paint the entire exposure to the ILFS group with the same brush. I think some people will end up taking some hits depending on where they have an exposure, and then there are some people who might have specific exposure to some assets, say a road BOT asset which is running as per expectation, which is throwing cash flow. So so despite that, they have taken a contingent provision. They said that they expect the asset to remain standard. It is still standard, and so I don't think and anyway, one thing what we have realized is that the ILFS exposure is distributed among a lot of disaggregated number of players. So there are mutual funds, there are insurance companies, there are specific corporates, and then there are banks. So it is not going to be a significant hit taken by one single entity. And on top of that, most of the exposure is again by PSU banks. So they anyway, they have been always exposed to most of these stressed assets, and this is another addition to that list.
Okay, is that why you're always staying away from some of the PSU banks? Is that a concern for PSU banks if anyone wants to take an exposure, that such unforeseen risks and the exposures to some people which they usually take can cause a problem? Yeah.
So that PSU we have always stayed away from because of the kind of indiscriminate lending that they do. So the private banks, I think, will gain in against PSU. So another reason why we like something like Indusind Bank is that one is that PSU banks are now much they are not so aggressive in lending, so that market share continues to shift from PSUs to private. And on top of that, lending costs for NBFCs has grown significantly, and Indusind has significant presence in the CV financing business. So I think there also they are now at a much bigger advantage as compared to some of these NBFCs. So overall, I I think something like Indusind Bank is in a sweet spot, and they should continue to do well over the next many years. The banks is slightly expensive at 3.5 times price to book. So, and ROEs are still, not at the most, attractive level. So they're still sub 17%. Maybe if they can reach towards that 20% mark, probably there'll be some kind of re-rating.
Okay, Foram, what did you make of Indusind Bank's numbers?
Yeah, so the prima facie, the numbers looks really very good, and on every parameter, be it the NII growth or the disbursements, even CASA has come really nice. Excluding this contingency, bottom line has also grown at more than 20%. So in every parameter, it continues to remain tall, But if we see, the valuation wise, as he rightly mentioned, it is at 3 times, book. So I would, if I have to do a comparison between Yes Bank and Indusind Bank, the fact that Yes Bank has seen a steep correction. So I think at current levels, Yes Bank looks much attractive in terms of valuations. So despite the fact that, Indusind Bank continues to give good set of numbers, I would want to skew a little towards, Yes Bank, and I would want to give preference to Yes Bank over Indusind Bank.
Okay, any reason why? Because only on and Yes Bank fell for a reason. It wasn't because of fundamentals. Is the overhang over on Yes Bank because of what Rana? Is that what you are playing on?
So if we look at Yes Bank, it has a successor problem. We still have to look who would be the successor of the bank. But then fundamentally, if you look at the bank, of Yes Bank again is growing at a good NII, and good loan book is also good, and everything is good as compared to or in terms of Indusind Bank. But if we have to give valuations and importance, so then Yes Bank takes the cream away, because it's being a Nifty 50 stock, it's trading at just 1.5 times book, FY20. So I would not want to shin this valuation factor away, and that is why I would want to give weightage to Yes Bank over Indusind Bank purely on the valuation basis.
Okay, do you all have official coverage on Indusind Bank on your
no, but we do like Yes Bank, and we have a target for Yes Bank of 300 rupees, So we feel that the fact that Indusind Bank is trading at 3 times book, it might hover around 1600, 1700 levels, but we might see quick run up in Yes Bank over Indusind Bank.
Okay, and Savi, before we end, you heard what the management of Indusind Bank had to say. How does his commentary lead to the setup of other banks now? Because pretty much all of them will rely on what's happening. So given the fact that other banks will also report, how does his commentary set the stage for the other banks to report numbers?
No, I think the growth is robust across the board, and so I don't see any reason why some of the other frontline banks should not report good numbers. So something like a HDFC Bank or a Kotak, or these banks should continue to do well. And I think the structural theme of loss in market share from PSUs to private banks, that's a decade, the next decade theme, and that will continue to play out, probably even at a more faster pace than it was happening earlier. So overall, we are very very bullish on the private sector banks, not so much on
top pick
PSU
in the which banks do you like in the private sector banks?
So we hold this small bank called DCB Bank. That's one bank we hold, and so that's our top pick, I would say.
Okay, Savi's spoken about DCB Bank in his earlier interactions with Bloomberg Quint, why they like it. But the next stock that we want to talk about is Avenue Supermarts. Now, a lot of high PE stocks have corrected. Avenue Supermarts came out with numbers, inline set of numbers to decent set of numbers. But now people are questioning whether the growth rate will continue on a base which is already growing at a very, very rapid pace, and add to it the high valuations that the counter has. But the counter is down almost 20% from the recent highs. Is it a good valuation to play for a very well-run retailer or a very well-run company? Foram, what did you make of Avenue Supermarts? Are valuations now justified? At one point of them they were exorbitant, or still are they exorbitant?
To be honest, I feel the valuations are still very expensive, and the fact that we've seen numbers have come really very good, but there hasn't been such exorbitant numbers that we give such premium valuations to the stock, and that is why if we look at I think margins have been fallen because they have taken a price hit, and they haven't opened more stores also in this quarter. So I feel that of course the numbers would continue to do good. There is no doubt about it, but I think at this valuations, like what 80 times something, FY19, I think it is not justified. So I would want the stock to correct little, from here on, and if it gives you a correction of more 10 to 15% from here on, I think then it becomes a justified buy.
Okay, and what did you make of the numbers that also came out with? It came out with results on Saturday.
Yeah, so numbers are good. Revenue has been growing at good 30%. Bottom line has also been growing at more than 15%, and I think it's continuing its good robust performance. But of course, as I said, margins did not look that good. So what I feel is for a company to gain or to sustain such premium valuations, it should be tall on every parameters, be it marginal increment or a good bottom line growth. That's when a multiple of 80 is justified on FY19 basis. I think valuations are too much stress, and the stock needs to correct, because now at this current juncture we are seeing many good quality stocks have corrected to a decent valuations. So I would not want to give buy for Avenue at current multiples. So I would want the stock, I would wait for the stock to correct for entering.
Okay, so you agree valuations are still very, very high for Avenue?
Yeah, so that is, I think, a universal truth, and more than 70-75 times 1 year forward earnings. So that's not cheap by any measure. But I think what the market is pricing in is the fact that they have 160 stores, and they can easily, no reason why in next 10-15 years they can have 1,000 stores. That's basically the thesis, that you have figured out the unit economics of a store, and you continue replicating that across a large number of stores. But that's easier, it sounds very easy, but it's not as easy to execute. So they have been expanding in contiguous markets. So from Maharashtra they have gone to Andhra Pradesh, to Gujarat and those states. So as that keeps happening, the operating leverage which was earlier playing out, that we believe will stop. If you look at how Walmart grew in the early 70s, 80s, when it expanded across its outside its core market, the margins actually started shrinking, the EBITDA margins. So that is because when you go to different markets, the learnings are different, and also the economies of scales do not play out. So that is number one. Number two is, I think, the increased competition, and that is from both online and offline. And now you're reading so many news of Amazon partnering say with a Future Retail or a More or a Samara Capital funding in partnership with Amazon, funding More, Spencer's being on the block. So there are a lot of private equity players and online players, and some of them are actually getting together. So, and then there is Reliance Retail, there is Big Bazaar, and also competition is there. And we believe that the secret sauce, so to say, which is there in the case of say Avenue, someone like a Damodar Mall, he was the founder of DMart, and he actually opened the first 2-3 stores. He is currently the CEO of Reliance Retail. So that competition is there. It's a credible competition, and how that is going to affect, for example, this time they saw 150 bips contraction in gross margin. So they always want to be the lowest price player, and if other players are going to decrease their prices, they will DMart, the value proposition is the lowest price. So that risk remains, and the operating leverage may not play out. So it's only going to be expansion in revenues, which I'm sure will grow at double digit for the next 10 years. But the pricing or the valuations is factoring in this and much more. So there is no room for error. There's no room for execution error, and therefore there's no margin of safety. And like Foram correctly said, we need to look at much reasonable.
What would be an ideal valuation for Avenue? If someone is looking to enter, she said another 10-15% correction. At what time? Because see, people will pay premium for a business, and that's what, and they're paying that premium for Avenue. Obviously, it will be much more expensive than the other retailers. So the valuation gap has narrowed now. It will further narrow. So what kind of valuation would be ideal?
I mean, we would look at it at least after, say, 1/3 further correction in the valuation.
Okay, another 30% downside.
Yes. So, I'm not saying that the company cannot grow into its valuations going forward. It can very well do that over the next 10 years. Eicher Motors always looked expensive. Page Industries always looked expensive. But in hindsight, we are saying we can easily say that they deserved to be expensive. But some things could have gone wrong. A credible competitor could have come and dislodged someone like a jockey. Just because it has not happened, we are assuming that it would, at that point also it would not have happened. So things can go wrong from going
so
forward.
Is that your view on the current, all the retail space as such? Because competition is such that, what's your view on the retail space? Is it a good place for someone to invest? Will competition always be there in this space that could create trouble for?
Yeah, we are very negative on the retail space. Someone like Avenue, which is got superb execution skills and a superb track record. Even that company is going to face competition from online. Online players have capital is one raw material which is not scarce for them. So even if you are very good at your job, it is not necessary that you are going to thrive. So that is the problem with retailers. Something like Aditya Birla, ABRFL. It's another segment of retail which is fashion. But they have been struggling because of competition, right? Because of discount, because of the end of season sales. They don't want to be discounting their, they don't want to dilute their brand by discounting them at every point of time. But you see what has happened because they've not done that. Other people have, taken away market share from them. So you cannot operate in isolation. You also have to look at what is happening around you. So therefore, we are very negative on the entire retail, be it grocery, be it fashion. There are one or two players like, say, Trent, Westside, which is doing extremely well despite what is happening around it. But the examples are only one or two. There is a Arvind which is struggling. There is a KKCL which is struggling. There is a ABFRL which is struggling. So even these well-managed companies are struggling. So
what about you? You share the same view on the retail. You said that Avenue is there, but overall on the sector, what's your view?
Yeah, so I second to his opinion, but then I feel that, demand is always going to be ongoing. We are seeing the kind of spending that's happening and all, and the spending is not just from the urban side, but also from the rural side. Hence, we cannot completely ignore the sector, and that is where valuations comes into picture, and that is why we should look at stocks which are little attractively valued and, which can give you a good returns from here on, because we have seen a very good correction. And again, I feel this sector should not be completely neglected. Hence, there are stocks like, Aditya Birla Fashion, which has just started posting with good set of numbers. V-Mart is there, which continues to post good set of numbers and are trading at decent valuations. I would want to go for those kind of stocks, rather than going and giving a premium valuations to, D-Mart.
Okay, so that's the view that's coming in. Valuation still expensive for Avenue Supermarts. The next stock we want to talk about is the housing finance companies, and it's been a bad time for most of the housing finance companies, be it Indiabulls Housing Finance or Dewan Housing Finance. Most of them have corrected. So we're asking our guest, is there some stock that they like in the housing finance space after the correction that they can pick up? Foram, anything that you like in the housing finance space?
Yeah, so as you rightly mentioned, the entire housing finance segment has seen a very good correction, and this could be taken as a buying opportunity. So there's one stock we like is PNB Housing Finance. The stock has seen a very steep correction, but if you look at the numbers, the only stock which grows at 50% on a bottom line level, and it is sustaining this growth rate. If you look at its AUM, again it's growing at 45% and more, and again NII is good, NPAs are almost negligible or less than 0.5%. So on every parameters it is continuing to do good. That is what is more important. It should maintain, despite the higher base, it should maintain its good up move, and that is what PNB Housing Finance does. If we see the market share, it has a good market share in the northern region, and we might also see it increasing, the market share. So it has always outperformed the industry, I feel, because the company has been growing at good 50%, on a bottom line. And we feel that the promoter stake sell is also, done. And I think all the bad news has been, factored in. And I think at the current level, again, such a big, housing housing finance, you're getting at just 1.25 times, book on an FY20 basis, which is very important. And that is why I would want to go for PNB Housing Finance, because we can see good 30% upside, in this stock.
Okay, what about you, Savi? Anything that you like in the housing finance space?
Yeah, so we believe the space is in the middle of a structural, slowdown, and there was a long period of where the housing finance companies survived. But now, I think we are questioning the entire business model itself, especially for NBFCs, not so much for banks. So you have these companies who have seen a significant increase in their cost of funding, and obviously they, it's not as easy to pass on that cost to the customer, because the customer has three options. Either he can go and borrow from a bank at a much cheaper rate, or second is he can just postpone that loan itself. It's a discretionary loan. I will buy a home later. It's not like a microfinance loan that I needed for my survivor. So those 2-3 problems exist for some of these smaller housing finance companies, and I think this will continue for a very long period. Both PSUs and private sector banks are very aggressive in this space, and either you will have to satisfy yourself with subprime borrowers, because your cost of funding is higher, and because bank is not lending to you, you are going to a NBFC. So therefore all these housing finance companies that are there, we are not very happy with their business model. However, I think the leader will survive. So someone like a HDFC, which has one of the lowest cost of funding, or something like a Group Finance, these, leaving aside the valuations, they probably will survive the onslaught, and also there will be consolidation in the industry, which will also help them become stronger. So that is one segment, especially in the plain vanilla housing loan to the salaried segment, we believe that only the strong guys are going to do well. And then there are niche segments like giving home loans to the self-employed, where banks are not very active, where you need a lot of paperwork, or where you are lending against a single unit or a single dwelling. It's not a part of a big building. So there is a player like Aviation Financiers, which recently came out with an IPO. Again, the valuations are very expensive, but that is one segment where the competition is not so high, the yields are much higher, the ability to pass on the increased cost is higher, because the borrower has no option but to come to these guys, because the bank will probably not lend to them, because he does not have an ITR, he does not have he is not filing his income tax. So these are two segments. Either go with a leader, again valuations expensive, someone like HDFC, or go with niche players like Aviation.
Okay, so that's the view that's coming in on the housing finance space. And finally, the top avoid or sell in this market at this point of time. So Savi, what should one avoid, or one should, if someone is in the FNO side, what can one short?
Yeah, so shorting, what my avoid is based on again a structural, so it might not be right to short the stock, because it may take a very long to for that to play out. But one space that we are negative on is the traditional media space. So Zee Entertainment came out with fantastic results, and I think the stock has also done well after that. But we are very skeptical of how the entire media landscape will look 5 years from now, because who will have market share, which are the players who will be relevant. There are a lot of players vying for the same space. Some people have a lot of capital, the likes of Netflix or Amazon Prime, and even the traditional media players have no option but to spend a lot of money on the entire OTT space. So with the data disruption and the OTT boom, we believe that the traditional media players might lose relevance very quickly, especially among the youth. One thing that there is this cliff of waiting for these traditional media players, because the content which was relevant for say your or my parents is no longer relevant for the youth, and they are spending most of their time on internet consuming media on either YouTube or Netflix or Amazon Prime, or even OTT platforms of these traditional players like a Z5 or a Hotstar, etc. So in that context, how do you remain profitable? And so the subscription revenues and the advertising revenues make a bulk of the of someone like a Zee Entertainment. We believe advertising dollars will continue to move out from traditional media to digital. So for example, Bloomberg itself is it's a digital platform, and so a lot of media budgets are finite, and a lot of that is moving to digital. And second is subscription revenues. We believe cord cutting is a real threat. I have myself, I do no longer have any cable subscription. So that will lead to a decline in subscription revenues, and that's why you're seeing these kind of fights between, say, a DEN Networks and a Zee or a Sony and a Tata Sky. So because there's limited revenues and everyone is fighting for that. So overall, I think if you have Zee, I think it might be the best time to sell, or you may not want to invest afresh in something like a Zee entity.
Okay, so that's the view that's coming in. The media space is something that Savi is talking about. What about you, Foram? Anything on that should be avoided, or should not be, or should be shorted, or has the potential to go down?
So I feel aviation sectors would still see a potential to go down, because of course the crude overhang is there. We have just seen crude surpassing $80 per barrel, and we might also see it surpassing $85 per barrel, due to the geographical overhangs and all. So I feel that where these aviation companies, they have 25% of their total operating cost in the fuel expenses. I think it's like a big chunk and it should not be neglected. So we did see last quarter, many of, or rather all of the aviation stocks did not report good set of bottom lines. So I think this would still continue, and that's why I feel that there's still room for 10% correction. Although we are seeing demand increasing for the PLF factor increasing and all for all these aircrafts, but again the fact that when it does not percolate in the bottom line, we feel it is of no use of PLF increasing, and that is why unless and until the crude doesn't settle down to below $80 per barrel, I think this overhang would always be there, and that is why one should wait for crude to come down to enter into aviation stocks.
Okay, so aviation and media are the two sectors that our guest spoke about. But with that, we're completely timed out on today's Hot Money. Savi, thank you so much for coming in. Foram, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.